Welcome back to another episode of Tank Talks. On this week's episode, we welcome Managing Director at 60 Degre Capital, Yatong Li, to discuss how the firm invests alongside some of the biggest names in venture. Yatong explains how the firm is able to invest from Series A to IPO and how his team is able to due diligence such a wide range of investment opportunities as a firm. Yatong explains how the current markets are impacting his firm's investment decisions and how they're analyzing later stage investment opportunities that are being written down 50%. Finally, we ask Yatong how their firm is able to be an LP in some of the greatest firms in the Valley while also being a direct co-investor, and some of the biggest lessons they've learned from all the investments and funds they've invested over the last several years that other people should hear. But before we jump into this week's interview with Yatong Li, we welcome back to the Tank Anthony Mouchantaf to discuss the news and stories making headlines in the tech and venture capital ecosystem. Well, we're back again here, back-to-back sessions with Anthony Mouchantaf from RBC. Welcome back, Anthony.
Nice to be back.
You know, it's been a little crazy after all the SVB news that was happening around the markets. Now we've got some other news here with some of the later stage tech companies in Canada having to suffer some fate that we didn't want to see happen this early in the year. But we saw Renault, who had raised over 150 million from some big name investors like Tire Global, as well as a lot of Canadian firms, as well as BDC, unfortunately not being able to stay afloat here and having to file for creditor protection. So, you know, what are your thoughts on this one? And how should investors interpret this news when a company like this that was reportedly doing over $10 million a month in revenue, unfortunately had to file for essentially bankruptcy? First
and foremost, I think the human element to this is terrible, right? I think you hate to see things like this, particularly with a company that, for all intents and purposes, as we understand, was executing well, was growing very rapidly, and was basically doing everything right, but ultimately appears to have been the victim of its time, in a sense. I think what's interesting to me on this one is it's not even so much the shift in the macro environment, but the velocity with which the shift happened caught the company flat-footed, and they couldn't quite adjust quickly enough. I think the other piece there is you see, and I'm sure many of your listeners would have seen the Globe article about it, the Sean Silkoff's Globe article about it. And it seems like whatever you can kind of surmise from that article, I think it's illustrative of investors getting really cold feet now on capital intensive businesses and where they're willing to deploy capital and kind of, we should say, redeploy capital. So it's an unfortunate turn of events for sure.
Yeah, I think that's a great point in terms of the capital efficiency of businesses. And like, not all tech companies are built the same. You know, if a company had raised 150 million or something like they did, and they really did have $10 million of revenue a month, if they were really doing traditional SaaS margins of, 70, 80%, you can really stay afloat for quite some time. But when you're running $10 million run rate a month, but your margins are maybe only 20%, that's when things start to get really hard. And that's what we're talking about here, which is like, yeah, you can see, they were doing really good things on the top line, but as it starts to flow through, this thing is just sort of, 1 foot ahead of the other. It's not really making much progress, unfortunately, on the businesses. And so when you think about these hardware businesses or real world businesses, it's not as easy when the macro environment changes so quickly to stay afloat. But you got to think like, the terms they were getting from these investors who were insiders or maybe partially outsiders must have been getting pretty aggressive and having to see 2 term sheets kind of fall to the wayside. What do you think really happened in that boardroom at the 11th hour that just didn't allow this thing to stay afloat?
I think we'll never know. What I will say, though, is it's illustrative of the nuance of VC that's lost in the popular imagination. And the reality is that VC funding is largely contractual. And what goes into ownership stakes is highly, highly variable. And what ends up happening in many instances is you have a board of directors with competing interests because their liquidation waterfall doesn't look the same. They have different time horizons, different whatever. And so when you have a situation where, candidly, different investors are representing different interests, you can have a situation where those interests clash. And it seems like that's what happened here, right? Because ultimately, and there's this philosophical distinction to be made that, many startup founders don't think much about, and candidly, many VCs don't think about. It's where exactly is the fiduciary duty endowed? Is it endowed to the fund that you're representing on the board of directors of a company, or is your fiduciary duty to the corporation itself as abstracted from its shareholders? And I think most people would argue that it's the latter. And what seems to have happened here, again, from the outside looking in, where you have a business that, by all intents and purposes, was executing, was growing, and was doing significant turnover, seems like there was a failure of governance here somewhere. And you would have liked to think that it should have been able to find some solution that would have avoided this fate.
Yeah, it's a great point you make here about how, VC funds, sometimes they're, significant majority investors combined in a business like this, but their job on the board of directors is to represent all of the shareholders of the business and not just the fund that they're sitting as a partner on. And that's often hard to sort of disconnect when these kind of situations happen. You also got to think how many people were turning their backs only at the last minute versus all the way through the process where other ones were really trying to get everyone together. And you're right. The part about VC sort of to blame here for this, I don't think is really fair because everyone has responsibilities and they all have to answer to somebody. We have to answer to our LPs in the long term, but we have to support our founders in the short term and beyond. And so I think when the media labels this as like a breakdown of the investors turning their backs on the founders, I don't really like that. I think that's a cop out here. I think there's a lot of finger pointing you can put on people, but at the end of the day, everyone has somebody to answer to. And so just to say that the investors, screwed this whole thing up and the company takes no responsibility, the founders take no responsibility. I mean, fuck, the investors are the ones who take all the risk, right? They're the ones losing all the money here. Yes, there are employees and stakeholders and founders that are obviously going to suffer as well. But, the initial impact is right on the investor. So you got to accept and acknowledge that. It wasn't like they're running away scot-free. We'll see here, but it's a sign of the times, I think, of how some of these later stage companies with very high valuations, with a lot of funding, if their business models don't have a lot of maneuverability because of that margin issue, there's not a lot of room for error when you're coming to market to raise some rescue capital, right?
Totally. I mean, I think what you're saying is totally fair. And laying blame nowhere. What's curious about this is it seems like no one quite blinked first, right? Like I'm used to someone blinking eventually and just British style diplomacy, right? Like you have different people with different interests and eventually you meet somewhere in the middle or one standard deviation from the middle. And for whatever reason, and I think this is probably a consequence of this economic environment where everyone's a little bit shell shocked and everyone's trying to figure out where to redeploy and how to support their portfolios. And on top of that, you have some investors who are not purely financially minded, right? Like I think there was a thread about more government type investors, which is something that I've spoken about ad nauseum, who are not really financially driven in a pure sense, right? And so not only do you have divergent financial interests, you have divergent fundamental interests. And I think in this environment where no one blinked, the whole kind of thing came crashing down, and it's really tough to see.
It's crazy that there was no break the glass kind of, or this is the break the glass kind of moment, and they actually did it. You would think someone would blink. You'd have to do a recap. You'd have to sort of do this rescue and things would just eventually climb back to hopefully a steady state, but they did not. And they ended up breaking the glass and just saying, rip the Band-Aid off. It's done. We're going to file for, creditor protection, which is really sad. So we'll see. Hopefully this isn't the start of a lot more of these in Canada, and hopefully investors will come to some agreement on how to keep some of these companies alive. But speaking of investors, the biggest investor of all, Canadian government released their budget. The 2023 budget by the federal government was dropped. I think it was a big flop. I'm not going to lie. But, there were some highs and some lows for a lot of people out there. What do you think the read of this one is, Anthony?
I tend to agree. I think largely underwhelming. I think outside of clean tech, there really wasn't much on the innovation economy as far as I could tell. And even the clean tech portion was a little bit, I don't want to say nebulous, but a little bit remote, right? It was mostly contained in tax credits, I believe, for project finance, but I don't particularly recall. But by and large, underwhelming. I think they did a good thing with again, if we veer a little bit away from tech, I think the grocery tax credits and assisting with cost of living, I think that's really important. I think, one thing that's really important to remember about inflation is inflation slowing down means nothing about the damage that's already been done, because I would bet that most working Canadians haven't seen their wages go up by, high single digit percentages. And so in that context, I think that's really good. But as far as it relates to our industry, not much ado about nothing as far as I can.
Yeah, I mean, the grocery one I thought was a good headline, but when you looked at the numbers, it was like $9 a week, which is not really big. So I think they relabeled a different type of initiative that they're just calling now the grocery support. There was nothing on open banking. We've been fighting for this for a while. I know startups are all complaining about it. You at RBC may not be, but interesting that there's just nothing still happening on that side of things. What gives?
I don't know.
Yeah. No comment. Well, we'll see. I mean, there's definitely a lot of things in there that we're missing, and hopefully we'll start to see more details coming out as the initiatives get rolled out. But on a brighter side in the banking world, SVB found a buyer in Citizens Bank. I mean, what a steal by First Citizens. I mean, it seemed like investors loved it. They acquired all of their life science and tech loan book basically for free, and the stock was up over 80% the next day. So, First Citizens has a reputation of buying troubled assets, basically getting the FDIC blessing. What are your thoughts on this one?
Listen, I think good for First Citizens. I think probably good for its shareholders. I think the core SVB business was really, really strong. I think the human capital there is candidly second to none. I think it's still a sad story. As far as I can tell, it's the SVB brand is being essentially decommissioned, and it's tough. SVB has been a fixture of the tech community basically worldwide for decades now. And again, it's hard to see, but you always hope in these situations that the human beings involved kind of land on their feet. And as far as I can tell, that's conducive to that. So that's a good thing.
I think it's a good thing. I mean, I do agree the brand and the reputation of Silicon Valley Bank is going to be pretty sad to have it not be a part of a name fixture in the ecosystem. But hopefully First Citizen recognizes the legacy that asset comes with and continues on the same sort of journey they were trying to do by allowing this ecosystem to really have a banking partner to rely on as they grow up the sort of capital structure ladder, if you will. Because we all know early stage startups just don't get treated the same way when they're dealing with larger banks, and they need a partner that speaks their voice when they need access to those types of products. Speaking of products, I thought this was interesting. Wealthsimple launched a private credit fund for retail investors in partnership, obviously, with their largest investor, Sagard. And, allowing retail investors access to a private credit portfolio, to me, seems a little bit off where a lot of investors are even thinking to put their capital right now. But given where interest rates are, maybe it's a good product. I just don't know. Are they throwing darts at a board here? What gives?
So I'm going to plead product market mismatch. I don't know if I'll be vindicated. I think it's a bit of a weird one, right? Like, I think it makes sense in an academic sense, right? Probably in this market as well. You go, interest rates are rising. They're looking to provide alternatives to their customers. You go, yeah, private debt probably makes sense in a world where it's 6.5% prime. You get some yield on top of that. My view is, and I say this basically only as a feeling, is that the clientele of a Wealthsimple probably doesn't find private debt to be all that sexy and probably doesn't align broadly with what they're trying to do. I think something like, veering into the venture space, for instance, like that's a little bit more Wealthsimple-y, I would think. But I don't know. Again, they probably know their market and their customer base better than I do, but a bit of a curious one from the outside looking in. Academically, though, I think it probably makes sense.
I mean, first off, they're saying you need to have a minimum of 100,000 deposits at Wealthsimple and must make a minimum investment of 10,000 in the fund. But how big, given that Wealthsimple has retreated back to Canada as their home base and given up a lot of the other markets they're going towards, how big can a private credit fund come from with all of the sort of small, medium accounts they have? I mean, I assume a lot of family offices that we talk to who have invested in private credit funds for a long time are not storing a lot of their capital at Wealthsimple to begin with. Wouldn't you think?
I think you're probably right. I think it's probably also a move upmarket for Wealthsimple, right? I think ultimately as they think about what they want to be when they grow up, I think you have to start thinking about, can we compete with the banks and traditional asset managers or traditional wealth managers upmarket, which is honestly where a lot of the margin is going to be.
And that's where they've always wanted to end up from the very beginning, is what I believe. They've had that white label product for brokers, for smaller brokers, not like the big bank brokers, to use to help manage their own portfolio models as well. But yeah, I agree. It seems like that's where they're trying to get themselves.
Now, again, though, I don't know if that's product market mismatch, right? Again, I have $100,000 in liquid wealth. I don't know if I put that in an emerging robo-advisor kind of money manager. But that's just me. I'm veering in a weird direction now.
Yeah, I go. I guess that begs the question is do we think the credit markets right now are the places where you're going to see the most alpha, given that there's obviously just so many people looking for credit? How are they going to get the best quality assets? Obviously, it's going through Sagard, and so they're white labeling that and giving it to their clients. But hey, maybe it's just another product to offer in the stack.
Let me give you one more hot take. Young people don't care about credit. They grew up in 0% interest rate environment for however many years now. It's almost like it's like a non thing. And they grew up in the world of crypto and hot VC and outliers and, the extremes of social media. I think credit is way too sober. It's way too sober. It's way too systematic, way too predictable.
As the young kids call it, ZIRP, zero interest rate policy, which is obviously funny because right now everyone's talking about hyperinflation and what this means for crypto. And obviously we've seen a bounce in Bitcoin, a little bit in Ethereum, but like everyone's thinking, oh, if this really happens and the US has to come in and print more money to save the commercial real estate market and all the other different credit markets that have asset issues, Bitcoin's going to $1 billion. But, I don't think it's happening right now. And I'm sure you don't either. But thanks so much for joining us in the tank today for the news rundown.
Pleasure as always. Thanks for having me.
Now let's jump into the tank for this week's episode with Yatong Li from 60 Degree Capital. Thanks for joining us in the tank today, Yatong.
Hey, thanks for having me, Matt. Excited to be here.
Yatong, I really appreciate you taking the time to share your thoughts on the venture capital markets these days and how venture funds like yours are assessing the investment opportunities out there. But before we get started, I would love it if you can give our audience a brief background on how you ended up in the investment industry and how you ended up in your current role at 60 Degree Capital.
I think like many other VC peers, I started my career in investment banking when I was a fresh graduate. And after a short time of very, intensive working, I decided to move to Toronto for a Master of Finance degree at Schulich, during which, I'm really happy that I found my passion in VC together with some like Schulich alumni. And we started with a small fund to invest in venture companies. And 60 Degree now is almost 7 years old. And I feel actually very privileged to have a chance to, work with some of the world's most brilliant minds. And as a non-VC background person, you can imagine actually how hard it is to break into the VC circle. So for my journey is a very tough one, but also a very rewarding one as well. I think 60 Degree 7 years ago was like a white paper. So I could really draw a lot of things such as, building relationships, making judgment in helping the companies to grow. I think I'm very blessed that we got some early success, such as, Schrödinger's IPO in 2020, which is an enterprise software helping pharmaceutical companies to build modeling for the molecules, and a few more M&A exit, and also marking up our portfolio company, Xavier. So since 2021, I got pushed to lead the technology investment for the firm. So that's how I ended up in my current role for 60 Degree.
And so when you were at the Schulich alumni, making some of those early venture investments, can you name off a couple of the ones that you made through the school alumni program?
One of the really first one is Schrödinger. Is a deal that we invested in 2019. Is one of really the early companies that we involved in, and we actually got the deal from our industry partner, which is called Wuxi Ipotech, and they are one of the world's largest CRO, and they invest in Schrödinger in the early days, and we were just keeping in touch with them, and they just a really short catch up call, and we mentioned that. We're looking for some interesting software investment opportunities. And the person was like, oh, there's a company called Schrödinger. You guys should take a look. And then we started to, speak to the CEO, Remy, and we got really impressed by a few, conversations. And then, really short time, we just decided to invest. And surprisingly, after just 1 year of our investment, we received email in actually a Wednesday morning. And the CEO is like, oh, we have some plan to be public. Do you have some time to chat today? And we were really surprised by this early success.
You make an investment in 2019 and it files for IPO 1 year later. That's a pretty good path forward in making some of your first few investments. But let's bring it back to 60 Degree Capital. You guys invest in software, digital infrastructure, healthcare, and biotech, as I've obviously seen on the website. How did the fund get started and how has your investment thesis evolved over the years?
Starting a VC fund is really not easier than starting a tech company. You need to, have an idea. You need to think about differentiation, strategy. You need to hire right people, investing your resources on the right directions. So a lot of similarities. So our differentiation is really positioning ourselves as a North American investor, based in Canada, closely working with the Silicon Valley guys. And when 60 Degree started, we were in touch with some family offices in Canada, and they were looking for people to invest in the North American VC opportunities. In addition to actually to only invest directly, we came up with a differentiation that we allocate some capital or fund to invest in other venture funds. So like there are several reasons, such as maybe first, like making some close friends in the ecosystem, and also second, expanding our deal sourcing channels, and also maybe third, like sitting in front line to know what the investment trends, what other top VCs are actually investing. They say a lot, but like you need to see what they're actually investing, from their reports, from your like conversation with them. So after many years of building the portfolio, we are now LP of like some most reputable like VC managers in the world, such as Lightspeed or like Andreessen Horowitz or like NEA, Initialized. And we're glad that we have those close partnerships to help our direct investment program. So for 60 Degree now, we invest in enterprise technologies and biotech companies like through, two separate teams. And we spend a lot of time on both internal and external effort. So internal means that we build our expertise like through, active research, like market mapping, and also keep hiring talents to the investment team. Like external means like we talk to corporates to understand their innovation needs, and we talk to other VCs, including our GP and also non-GPs, to exchange insight and also opportunities. We also keep in touch, with our founders to add our value. And since we invest in enterprise infrastructure technologies, our team can be actually quite geeky sometimes, as we talk a lot of on data, computing, etc. And also since every VC sees us evolving, I'm sure ours will also not be the same like always. I think the one principle is just we keep trying to support the best founders.
Yeah, it's interesting. You came up with a strategy to start investing as an LP in top tier Valley-based VC funds in order to start expanding your network and building relationships. And so, you got into some pretty impressive VC funds, as you mentioned, like Lightspeed, Andreessen, NEA, and Initialize, among many others. What was it like? Did you fly down to the Bay Area and spend some time there networking? How did you land on these specific funds to start building your network out in the Bay Area? Obviously, there's a bunch of top tier funds, but let us know how you thought about picking these ones.
Getting access to those VC funds is not an easy job. When we first started, like we didn't really have the full resources to invest in top tier like VC fund in the Silicon Valley. So we took some time to build the relationship. So for me, I think even like for now, I still like travel very often to Silicon Valley. Like I would say every month I have to be there just to, talk to our GPs and talk to other VCs, talk to, industry partners, so that we can be in the circle and also be the, like one of the participants in the Silicon Valley, community. So that's how we gradually kind of like build our presence there, and also being closer to those like top tier VCs. And when we got access to the VC fund, I think like a couple years ago, we also got like very excited because it's like very hard.
That sounds like a perfect way to start building out your network, obviously, in the Valley. But you obviously started to evolve into more of a direct investment program, and obviously across multiple sectors. Given that you are investing across multiple stages from Series A to IPO, how are you and your team able to do diligence such a wide range of investment opportunities?
A skill set to really invest in early stage companies and also later stage companies are quite different. So that's why actually you can find people, with strong product and also founder experience in our team, since they are like covering a lot of like early companies did like due diligence work. Also, you will find, people from like, consulting, finance, or maybe M&A background in our team as well, because we believe that's also like required to conduct like a very detailed financial and also strategic judgment for investing in like a very mature or like IPO ready company. But like since no matter like early or late, we are laser focused on software and also digital infrastructure investment. There are like still lots of like overlapping knowledge for all the team members to share. And for example, we maintain like a very strong corporate network in North America and keep talking to key industry players such as Intel, Samsung, Salesforce, etc. And the industry insight they shared with us can be very helpful actually to both early stage investing and also later stage investments. And I think it's also maybe worth noting that we want to build a full lifecycle investment firm, which is now restricted by the stage. So we think no time is a wrong time to invest in like good company. So we wanted to keep the options open.
And when you're talking about speaking with some of the key industry players, like you mentioned, Intel, Samsung, and Salesforce, are you speaking to the corporate development side, the investment side, the product side? where in the organization are you trying to get your insight here? Because each department may say different things.
So we try to actually speak to, different type of people from like one corporate. So CVC, I think, is one of the closest, partners we have for those corporate. Like they already running investments and we share deals, we share insight, and we learn about like what's their investment direction. That can really help us get our investment as well. And vice versa, like if we have any interesting companies, like, interesting product, we can share with them and they can take a look and they will push those like interesting companies to their business unit to do like a consulting session, just hear about like their opinions. So we also build a lot of direct dialogue with those business unit like decision makers, like, CISO or CTO, just to understand what's their demand, what's their like thought on the company or the investment that we are doing. So we can also like get a lot of like really deep insight from those people. So we're trying to build like different channels within like even just one organization, especially for a large one.
Well, today's topic obviously is how does a Canadian firm make its way into the inner circle to make those opportunities happen? So how did you guys start getting and sourcing opportunities to invest in, especially in the digital infrastructure space, which is a very hot area for cloud infrastructure and data infrastructure among the Bay Area VC funds? It's not often they let an outsider like you guys into these rounds. So how did you start sourcing those opportunities to invest in?
I want to really mention a little bit more about like our infrastructure investment. So 60 Degree really separate the infrastructure investment by cloud infrastructure and also data infrastructure. So other than the application layer, boom cycle we had maybe in the cloud industry in the maybe past like 10 or 20 years, we need more innovations to make the underlying infrastructure more efficient and also flexible and also more reliable. So the software innovation is always like a spiral, like which means the application layer innovation and the infrastructure layer innovation take turns to be the focus for the industry investments. So the logic behind it is simply as people need more powerful maybe pick and shovels when they realize they couldn't dig more gold with the current one. So when we started to invest in digital infrastructure space, we started with, mapping the industry to find out what are the bottlenecks for the existing infrastructure space and also whether those sectors are ready for innovation and investable. Once identify the trend and also the right investment direction, we start to speak with our GPs, VC partners, and also corporate VCs, KOLs, just to verify our thesis and start to source investment opportunities. We truly believe the innovation never stops, no matter when we are in a bull or like bear market. And that's why we invested actually 5 portfolio companies last year across sectors such as, edge computing, data privacy. We also did one in gaming infrastructure, and we did one in cybersecurity, and also machine learning ops, etc. Our team feels even actually more excited about the investment this year in 2023. And we are continuously like deploying capital together with our partner, especially with SaaS, experts such as you and also the Ripple team in Canada. So we're trying to build more exciting portfolio company in our portfolio in this year.
Yeah, it's been really exciting working with you guys and looking at opportunities together. Obviously, with our focus on infrastructure and obviously developer tools, there's a lot of overlap between our thesis and yours. But when you start to look at some of these direct investment opportunities, do you find yourself doing a lot of your own due diligence before you have a conversation with the GPs or the VC partners or even the corporates? Or are you gathering it from all of those parties and then filtering it down into your own thesis at the end?
I think it's more like the latter one. So we take a very active approach to source deals. So it's more like a top-down process. So we identify trends and also find investment or investable like sectors. And then we go through the companies in those sectors and just gather all the information possible, like through the public sources. And we also speak to like industry, corporate, and also like other VCs just to understand they also like making some similar bet on the trend, because we don't want to like invest in something that all the other people like think reversely. So once we have those like idea and also pretty confirmed like investment thesis, we just go to PitchBook or like maybe Crunchbase just to screen all the companies, and then we find our channels to get connected. Before we taking any introduction call with any founders, we actually already like done a lot of research, a lot of like due diligence, understanding preparation just for like a high quality conversation. So we did work before the call.
Yeah, definitely noticed that as well before we've introduced founders to you guys. And it goes, very much appreciated for our founders to know that they're speaking with somewhat experts in the area that they're building in. I also want to understand how this thesis, though, has evolved over the years. You talk about investing in a bull market and now obviously entering into a bit of a bear market. How has the investment thesis changed and how has your deal flow sourcing changed over the last few years?
It is true that the technologies actually keep evolving, but actually our underlying thesis actually has always been the same. Like, for example, we have been investing in developer tools and also cybersecurity sectors, since maybe like many years ago, as we believe empowering developers and also strengthening software development security layer is a fundamental building block. Like, we also started to invest in like machine learning maybe around the same time, as we think is also like a key building block to the next generation enterprise applications. So just thinking actually how ChatGPT can improve and change the existing enterprise workflow already actually make our team quite excited. I think for deal flow sourcing, we always do both like inbound and also outbound like approaches. And we cold outreach, we talk to investor peers, we do top downs, we go to conferences, pretty much the sourcing channel you can imagine for a VC. I think one thing special about us is we also have a GP group to strengthen our deal sourcing channels. Although we don't really take too much passive co-investments sharing from our GPs due to our like relatively targeted investment sectors, we still do an active screening approach, which means we pick a few companies that from the GP portfolio that fit into our thesis, and we keep catching up with the GP just in case there is anything we can be helpful. Having those GP relationships means a lot to us. It's like you have someone that you trust with your capital, so you can share things and talk things freely. I think just between like maybe even 60 Degree and also Ripple, I think we also did a lot of work, and for the really great investment that Ripple has invested before, I think there will be a lot of interesting things that we can work together as well.
Yeah, I appreciate you saying that because we do have some GPs invested in our fund who kind of, want us to give them the heads up before a company goes out to fundraise or just as they go to fundraise. But I think the approach that you guys are taking where you're scanning the portfolio often and also reaching out proactively to the GP to get in front of the companies, even before fundraising happens, well before, is much more helpful from a GP's ability to manage LP relationships, but also managing founder relationships. Because sometimes founders are saying, well, we're just about to start a fundraise. Why don't we just include those, GP LPs in the process? But if you're getting in front of it by, a couple quarters, it actually helps build the relationship ahead of time, which is really important for the way that I think you guys do it. But let's talk about the due diligence process for a second, because you guys are investing across different stages. So making capital commitments must have different type of processes for different stages, I would assume. So what is your typical due diligence process like for making those capital commitments?
We usually start with an introductory call to introduce 60 Degree. I think just pretty similar to all the other VCs. And we also ask some high-level questions based on our previous research, since a lot of companies that we speak to are from our top-down research. So we already have some color on the business. Then we usually actually request a company deck and financial numbers after the meeting and start doing deeper due diligence or deeper research on the product, market, competition, and team, and also maybe financing history, etc. And schedule some more Q&A with the company after that, after we work on the materials and also research. So typically, I think after this stage, we will decide on whether to do a preliminary due diligence discussion with all the team members just to pass on the deal. Our principle is really not wasting everyone's time. So if we realize early that a company is not a right target for us, so we will just reject right away. If the deal got passed from our prelim DD session, we actually come to a stage which we call due diligence stage, and that means we will contacting our people VCs, corporate existing customers, or potential consumer customers as well, and industry KOLs, just to learn as much as possible about the investments. And the team will do a final due diligence session or discussion just with all the details we got from this stage, from all these reference calls. Then we can make a final decision on the investment. That's a really typical process we go through. Sometimes it can be pretty short, pretty efficient, just a few weeks, maybe 2 weeks, and sometimes it can be in pretty long time if it's like a very complex and later stage investment.
Yeah. And have you ever brought a deal to one of your VC partners while you're looking at it first and then have them join in and actually co-invest with you or even lead the round?
One really good example is our investment last year called Pragma. It's a gaming infrastructure company. So it's a really good example for our GP kind of like relationship deal sourcing channel. So we actually screen out. This GP is called Upfront Ventures. It's one of our really close partners in the US ecosystem. They are based in LA. And we actually pre-screened all the portfolio companies. And based on our infrastructure investment thesis, we found, okay, like this company Pragma is very interesting. They're building backend system for all the gaming studios and exciting trend. Because the gaming studios like need some people to really help them to figure out the backend stuff. Like they don't need to handle like by themselves. So when we found the company and we reached out and also we got connected with the CEOs through our upfront like venture friends, and then we started talking and we decided to invest actually after a few weeks of due diligence. But at the time it's actually early 22 and the company didn't really have a plan to raise like a formal round. So just because of our interest, the company decided to open actually like a small like a round just to bring in some investors. We were kind of like leading the process and set up the terms. And we actually also brought top tier VCs like Greylock and also some other like Silicon Valley VCs in. So we led some process like that before, but we still really trying to work with our partners to, like maybe follow our like co-investing in some rounds. Leading investment take maybe 10% of our investments.
Wow, I love that. Canadian VC family office LP, bringing together other VCs from the Bay Area for a California-based investment is a pretty cool way to look at you guys. But I'm sure that the early stage investments have a bit of a different due diligence process. How are you assessing early stage investments in venture, given how limited the data is compared to some of the later stage opportunities?
We actually understand those two type of investments are quite different from each other. So for early stage investment, our expectation already got set at a pretty low level, like regarding the detail that we can get. Like, for example, we won't really request, let's say, audit financials for early stage companies. And we won't really make our decision based on too much on the metrics, such as, metric numbers, unit economics, NDR, etc., just because it's too early for us to see like a stable pattern for the company in an early commercialization stage. So yeah, we already have like a much lower expectation on like regarding the details on early stage. So we can still like make decisions based on whatever we have.
Well, at the stages that we invest at Ripple, at the pre-seed stage, there's even less data to go on. So we'll make sure that when we bring an opportunity to you, it has a little bit more than what we get when we look at the company from a very early stage. But, let's talk about the current markets, and how it's impacting, your fund's decisions on capital commitments. Obviously, I want to touch on what's happening with Silicon Valley Bank and the broader, banking ecosystem. But first off, like, what are you seeing out there and how ugly is it for some of the later stage investors out there?
The valuation environment actually has dropped like a lot, like since 2021 high, level. People who heavily maybe invest in the later stage venture in 2021 now is seeing some pressure on, marking down their portfolio. But like for 60 Degree, I think we were really not rushing our investment. At the year, like in 2021, we always average our investment pace without really rushing or slowing in any time. So we didn't get hit too much, by the valuation environment change. And also I think maybe also worth to mention for early stage investment, we actually have also been keeping our pace. We finished our Fund 2 investment last year with a few new portfolio companies joining us, such as, Marco Meta, which is a post-Series A convertible note company, and Paperspace is a machine learning ops platform, which we invested also their pre-Series B convertible note. So I think for early stage investment is really not really impacted by the market environment change in the last 2 years. So we're still keeping our pace in the early stage investment and working with our high quality partners like Ripple Ventures just to, keep sourcing, keep investing. But for later stage is can be like pretty tricky for the last 2 years.
Yeah, I mean, for sure, a lot of people are seeing all the, the valuation cuts that are happening at the later stage where early stage is somewhat isolated. And a lot of those are also being done on maybe some safe notes or converts. So you're not really getting the same price on the mark to market side. But, what are your thoughts on bigger names like Stripe slashing valuations by 50% to raise $4 billion? Are those kind of rounds even interesting to firms like you? Or are you trying to kind of hold back on getting brought into some of these really later stage rounds that are kind of happening at depressed prices from last year? Are you guys considering those in this kind of market?
Yeah, actually we do. So I think for later stage companies, I think the current market right now is really like a testing period for companies' flexibility on switching, growth mode and also profitable mode. The companies that are actually maybe slow to switch, they have to raise money to keep the light on. I think raising money or raising capital in the current market environment is not an easy job, for sure. And I think companies need to manage their priorities to make sure they can survive the market downturn. But I think for early stage companies, I think they can quickly grow into valuation, so the impact is much smaller compared to the later stage ones. So I can't really disclose what kind of deal that we are looking at right now, but I can say we are actually involved in a lot of big names, later stage company processes, through our connections in the US. We think some of those opportunities are actually very attractive, and we will execute on some of them. I think this year the companies, later stage company, already taking some step back just to lower down the valuation a little bit and putting it to a more reasonable level. So it's making the investment actually very attractive, because fundamentally those companies are still very high quality ones. So if the price is right, the timing is right, why don't we invest, right? So we are still pretty active on that.
Yeah, well, one of the deals that you announced publicly that's pretty exciting is your investment in DataGrail, which one of your VC friends at thesis Ventures that we know well suggested that you have a look at. Can you walk me through that thought process on that investment, and what kind of returns are you underwriting for an investment like this?
Our VC friend thesis Ventures suggested that we have a look at DataGrail. We actually went pretty deep on the market to see where the opportunity was. Since after our GDPR was enacted almost 4 years ago, what first, grabbed our attention was the rapid market growth, which is over 40% year over year, driven both by consumer pressure and also, by emerging regulation. We think that California's CPRA, which actually enacted in 2023, will be another major catalyst for industry growth, and also will reinforce the need for platform like DataGrail for years to come. Second, what really surprised us was that many of the DataGrail's contemporaries actually either try to be an incomplete, all-in-one solution for privacy and also securities, or they offer an anemic workflow that failed to scale. DataGrail's approach to first deeply focus on the automating data privacy resulted robust tech platform that we believe in the long term will all compete their closest rivals. I think this platform enables the company to address the bargaining middle market, for which competing solutions are weak, and enable it to adapt a future regulation and new opportunities to more easily in the data privacy and security. For the return target for DataGrail, we actually typically looking for 20% IRR for actually all kind of investments. For early stage investment, it taking longer time, maybe 3 years, 5 years, or even longer, our TVPI return, our dollar on dollar return can reflect the number. And for IRR is always around 20% across the investment portfolios.
Interesting that you have the same IRR sort of for early stage as later stage. We don't look at IRR, obviously, because the timing is so long for early stage. We try to look at it from a total return of capital. So, DPI, but, TVPI in the short term, DPI in the long term. But I think we look at things somewhat similar. I think our LPs would say probably 20% net IRR is somewhere where they'd like things to shake out at the end of it. But it's harder in the short term to really predict IRR. I want to make sure we talk about what's happening in the market right now. Obviously, Silicon Valley Bank, we're recording this after we've heard that the government is going to be stepping in. It was a pretty scary weekend. I'm sure you had some conversations with some of the VCs that you invested in, as well as the portfolio company of direct investments. What are your overall thoughts on what's happening and how this will play out over the next little while for both VC funds as well as LPs and direct investors like yourself on the VC industry?
What a crazy weekend we had, and when SVB issues started, I think Wednesday night, and also getting into Thursday and Friday, we started to realize the situation could be actually much worse than we first expected. And then we started to reach out to our portfolio company just to ask them to, either transfer some money to their other alternative like bank account, and also making some preparations for like a potential collapse of maybe SVB. And so we started really early to prepare for this. But like even with that, we still got a lot of like pretty rushed communication with the founders over the weekend, just trying to find ways to really minimize the impact by this. It's really good to see that, on Sunday, in the US, FDIC actually stepped in and also pretty much like, guaranteed all the deposits like are safe. So then like our founders really took a relief on that. So I think US government is really actually made a pretty efficient and also right move on this one. I think they like we had a lot of lessons learned from maybe 2008. So I think this time we already like foresee a lot of like consequences if we don't really step in the early days. So that's good to see. But I think for the long term, I think this the Silicon Valley Bank issue is not only for SVB. It's actually happening to a lot of like banks. Like rising interest rate at this high pace, actually creating a lot of like treasury pressure for all the banks, and also creating like having the SVB issue also create a lot of trust issues. I think for like some centralized players, or like even for the system or community. So for us, we will just keep deploying our capital in the venture companies, but like we also need to manage our conversation with our LPs just to make sure they are still confident enough to deploy capital in the VC like ecosystem. So I think that's the job that we need to do like in the next maybe couple months, just to make sure this SVB issue can be transit like smoothly with our stakeholders. Last thing I really want to say, like I think the Canadian banking system is so mature. I'm really proud that our Canadian banks are like very stable, like just making all the appropriate like approach to make sure the depositor like money is like very safe. So I think being a participant also in the Canadian ecosystem, I feel like we're proud to, especially compare the like Canadian bank players like with the US ones.
Yeah, one funny point I saw someone mention is now people are going to ask in their due diligence process, what banks are you holding your capital with, as part of a checklist of due diligence questions to ask a startup, which was not really something, we had ever had to ask. Most of our companies are either with the big Canadian banks or they're with Silicon Valley Bank, Comerica, or somewhere else. But now I think it's going to be something people ask, especially for early stage US based companies, on where they're putting the capital that they raise from VC funds. Speaking of lessons, what are some of the other biggest lessons you've learned from all the investments you've done over the last 7 years in both VC funds as well as direct investments that other people should hear? Looking back for my last 7 years investment journey, first one, I would really say maybe cherishing every opportunity to really pull the trigger. Doing VC investment is actually a very privileged like job. We're using investors' money, investors' capital to invest in some people's dream. So we need to be responsible and do whatever we can to really make it right. I will add maybe like a second one. I will say there's no shortcut for VC. I think people can get lucky for once or twice or even maybe 3 times, but they cannot like win just forever by luck. So I keep really reminding myself, if I want to be like a smart investor, I just do what I need to do, doing research, talking to the founders and learning like maybe new things, like going to conferences. There's really no stop sign ahead. I have to do whatever I have to do just to keep things right. Yeah, I'm really happy you say that, because a lot of people think like everyone in VC is just rich and just, throwing capital around to see what, is going to be the next lottery ticket. But a lot of VCs don't actually know if they're going to be good at their job for at least 10 years. And if they have actually made, a good amount of money, it's because they are good and they have been around for more than 10 years to even get that carried interest check. So a lot of the people who are successful in the VC world are actually just the LPs themselves and the founders. They're the ones who see success first. And the VCs are usually the ones who see success at the very end of the journey. So I'm happy to hear you say that. And yes, it is a huge responsibility and a privilege to be able to take investors and LPs capital as well as my own capital and invest in someone's dream. But it also is a responsibility. And we have to make sure we do everything right to make that successful for everyone involved. So I appreciate you sharing that. Last thing, before we wrap things up, is always ask our guests for their fast favorites. So first off, your favorite podcast. Definitely Tank Talks.
I listen to actually Tank Talks all the time. I think it's really good to have someone in the community doing this to really hear the voice for different like participants in the industry. Thank you so much, Matt, actually for doing this. I think like I will just keep listening and also getting my, insight and knowledge from you guys.
I really appreciate that. Thank you. Well, next is your favorite newsletter or blog.
I don't really have a lot of time to really read all the newsletter or blogs, but I think I read really the information every day. Is a pretty good newsletter that I follow, and I follow some venture capitalist blogs such as Thomas Hungus or like Nikhil from Footwork and some other like really good ones.
Yeah, Thomas from Redpoint and Nikhil Basu Trivedi from Footwork NBT is a great blog to read. So good shares on those. Next is your favorite tech gadget.
Does e-scooter count?
In the wintertime in Canada? I don't know.
Yeah, but I quite enjoy writing that.
How far do you get on that? Like, what's the farthest you've gotten on your e-scooter?
When I'm in San Francisco, I always take e-scooters. I don't really take Ubers because San Francisco weather is pretty nice. And I just doing that, for ESG reasons. And also, it's pretty enjoyable experience. We also invested in Lime, so
oh wow!
So it's good to contribute a little bit of revenue on that.
It is absolutely. Next is your favorite new trend.
After ChatGPT came out, I just keep asking questions to ChatGPT. It's so fascinating to see how it responds to my questions. It's getting so intelligent right now. So that's something that I really enjoy doing. Like my favorite new trend right now.
What are some of the most recent questions you've been asking it?
I asked about like what answers should I give to your questions in this podcast, and
that makes sense.
Yeah,
it's done a pretty good job so far. Yeah, very. Congrats, ChatGPT, on doing the podcast. Favorite book?
I'm recently reading the Ray Dalio's like principles for dealing with the changing world order. Is very really good theory to just talk about like how the like cycle changes and like is just help me to understand like why the world is like right now. So yeah, that's the book that I'm reading. Really enjoyed.
Very, very relevant for today's current situation around the geopolitical landscape. So great share there. And last but not least, your favorite life lesson.
Right now, my favorite life lesson is just sacrificing your health for success or wealth isn't really worth it. So health is always the first.
Health is definitely greater than wealth. Very much appreciated. And thanks for joining us on The Tank today with Yatong Li, Managing Director at 60 Degre Capital.
Thank you, Matt.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter at Matty B. Cohen or at Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,